Not all income is created equal in the eyes of lenders. Ever wonder why some people just breeze through the mortgage process while others hit snags? Well, it all comes down to how a lender actually views your job as well as your income. Now, before you panic because you have gaps of employment, or maybe you change jobs, or maybe because you have a variation in income, make sure you watch this video to understand how lenders actually look at your income as well as your employment and how that affects your ability to actually qualify for a home loan. Now, that's exactly what we're going to talk about in today's video. We're going to talk about stability of income, as well as different types of employment, your debt to income ratio, how it's actually calculated to determine how much home you can afford to purchase, as well as your impact on job changes, as well as employment gaps, so that you know exactly where you stand if you're considering buying a home. Now, before we dive into the meat of today's video, I'd like to take a minute and ask a favor. If you find any value in my content at all, do me a favor and hit that thumbs up. And if you want to stay updated on everything real estate and mortgage related, do me a favor and subscribe to the channel. Now, I want to start today's video by actually talking about the stability of income and employment, because that's really the baseline for what lenders are looking for when it comes to determining whether or not you're actually approved to buy a home. Now, the basic guideline reads that lenders want to see a 2-year work history with essentially consistent income and employment during that period of time, which more or less means you don't have a lot of variation there. You've either been on the same job for that same period of time, your income is pretty consistent, or if you've been in the process of changing jobs, you're staying in the same line of work. And we're going to talk about this in a little bit more detail, but that's more or less the baseline for what lenders are looking at. Now, if you're somebody that's been unemployed for the better part of 2 years, or your income has changed a lot, maybe you were making a lot more money a couple of months ago and now you're making a lot less, that can actually create problems when it comes to that stability part of what a lender is looking for. But with that, I want to spend a little bit of time here in talking about the types of employment. You typically have salaried employees, you have hourly employees, you have self-employed borrowers, which can include both owners of companies as well as self-employed contractors that just do different types of work that essentially work for a lot of different people at one time. And all of these different types of employment come with different calculations when it comes to looking at your income. And that's typically why a lender wants to see a 2-year history of your W-2s, of your pay stubs. If you're a self-employed borrower, they want to see your full tax returns. That includes all schedules. Now, if you're self-employed, they also want to see the business tax returns. If you're a business owner, because they want to look at the K-1s and see what the distributions are there. And the main thing to keep in mind here is if you're self-employed and you write off a lot of your expenses, they're looking at your income after your write-offs. They're not taking that gross income and using that to determine how much you make per month. They're actually taking your income after all of those expenses are written off, and they're using that number. Now, occasionally there are things that can be added back into your income depending on how you do your taxes, and that's why it's very, very important to make sure you're working with a mortgage professional when going through the process. I do these videos just to give you an idea of how income and employment works. You should never use this type of video to determine whether or not you qualify for a home. Rather, you should actually speak to a mortgage professional, go through the process, let them see your W-2s, let them see your tax returns, as well as your pay stubs, and let them determine the income that will actually be used in the process. That way, if there's any questions, they can actually run it by someone that works at the lender that you're trying to get approved, just to make sure you're good to go. Now, if you're watching this video and you have no idea where to start, my team and I would love the opportunity to guide you through that process. There's absolutely no fee required, and all you have to do is go to that referral link in the description below. Now, one of the questions that often comes up when talking about things like this is how soon is too soon to start the process? And I would say it's never too early to go through the pre-approval process, especially when you have questions around income and employment, because these are things that can actually keep you from qualifying to buy a home. In some cases, these are things that you can actually work on while you're kind of in that standby period, determining on when you're actually going to pull the trigger. So the sooner you do it, the more time you have to actually work on the things that could put you in a better position to buy a home. Now, I want to parlay off what we just talked about, where we were talking about the different types of employment, because there's also different types of income, and that is something that is super, super important to understand, because not all your income might be calculated if you haven't been receiving that income for at least a 2-year period of time. So essentially, most people, when they're salaried, they have a base income, and on top of that, they might do some overtime, so they have some overtime income, and then they might actually get bonuses at the end of the year. And if you're a borrower that's been receiving bonuses and overtime for a 2-year period of time, then chances are the lender can actually use that income in order to help you qualify for a home. But let's say, for example, you started a job 2 years ago and you've just been getting a base salary, but within the last month, you started to receive a bonus or maybe started doing some overtime. Chances are, because you don't have a 2-year history of actually receiving that overtime and bonus, the lender won't actually be able to use that income towards your gross monthly income. And that's what a lender is going to use when they're trying to calculate your debt to income ratio. Your debt to income ratio is based off your monthly debts, which is essentially all the things that report on your credit report, things like your car payments, things like your credit cards, things like student loans, anything where you had to apply for credit, maybe it was furniture. The stuff that shows up on your credit report, those are the debts that they're using in your debt to income ratio. So now that we've determined what the debt is, we have to figure out what the income is, because it's a debt to income ratio. It's how much debt versus how much income you have is what they use to determine how much home you can afford. Well, your income is based off your gross monthly income. Now, if you're a salaried employee and you have a consistent salary over a 2-year period of time, essentially they take that amount, divide it by 24 months, and that would be your gross monthly income. So let's say, for example, you make $120,000 a year. You've made that consistently for a 2-year period of time. Well, they take that 120 times 2 years, that's $240,000. They divide it by 24. That means they're using a gross monthly income of $10,000 per month. Now, if you're watching this going, Jeb, that's my gross monthly income. That's not how much I take home. I pay taxes on that. I pay money into a 401k. I pay medical benefits. I pay other stuff. So I'm not actually bringing home that amount. Trust me, I completely understand what you're talking about, but the lender is still going to use the gross monthly income because that's the most consistent way to measure one employee versus the next, because different people have different exemptions. They have different things coming out of their check. So the most fair way to keep it equal is using the gross monthly income. Now, if you're self-employed, this can be really, really tough if you don't truly understand your tax returns, because there are different things, like we mentioned earlier, that can be added back into your income, like depreciation, like some other things that could end up changing your income. And a lot of time in talking to self-employed borrowers, they just know what they made per year. They don't actually know how much they pay taxes on. They don't know what their tax returns say because somebody else did their taxes and did all the write-offs. So they end up paying taxes on a lot less money because of those write-offs. Well, unfortunately, the lender is going to use the income after all of those write-offs. And that's why it's super, super important, like I said earlier, to make sure you're working with that professional, just to make sure you're getting the right calculation when it comes to your income, because your income affects everything else. It is what a lender is going to use to determine how much home you can afford. So if the person you're talking to on the phone isn't doing the right calculation on your income and they're telling you that you're approved to buy a home, then there's a really good chance that maybe you're not approved to buy a home, or maybe you're not approved up to the amount that they say you are because the calculation was done incorrectly. So just make sure when you're going through that pre-approval process, you are working with a professional. Again, if you want to work with me and my team, there's a link in the description below. Now, the next thing I want to talk about is really the most important and where I see a lot of questions when it comes to income employment, and that is changes of employment or gaps of employment, changes in income, all of that, because the lender makes that blanket statement that we need 2 years of consistent income and consistent employment, which makes most people think, well, if I have a gap, then I'm not approved or I'm not going to be able to qualify for a home. And that's simply not true. In fact, if you've been laid off, if you've had a change in circumstances, if you had a medical leave, something happened and it caused you to leave work, these are all things that a lender will take into account of why you might have a gap of employment. But what you want more so than anything else is consistent income and consistent employment. You don't want multiple gaps over a 2-year period of time. You don't want major changes in income during a period of time. It's okay to change jobs, but ideally you want to stay in the same line of work. You don't want to go from being a W-2 employee, a salaried employee, to becoming an Uber driver and being self-employed unless you have a 2-year work history of being self-employed. Because if you do that, then chances are the lender's not going to be able to use your income. And that's because essentially you aren't staying in the same line of work. Now, on the flip side, if you were a server at a restaurant and then you became the manager of a restaurant, that's the same line of work. Yeah, your job title changed a little bit, but you're more or less doing a similar type of work. So in that case, a lender would probably allow it. Now, at the same time, if your income is consistently going up, chances are the lender is going to average that income over a 2-year period of time. Whereas on the flip side, say last year you were making $100,000, you made a job change, and now you're making $75,000. Well, in that case, the lender might not average your income because your income is going the other direction. Instead, they might use your recent income to determine your gross monthly income, which in turn means you're going to have less income over that 2-year period of time. But hopefully that's not the case. Hopefully you're not changing jobs from a higher paying job to a lower paying job. Hopefully it's going the other way. But where I see a lot of problems around this at the moment is a lot of people have side hustles. So they have their regular job. They have, whether it's a salaried job or an hourly job, they have consistent employment that they've been earning over that 2-year period of time. But say within the last 6 months, they started doing YouTube and they're getting paid ad revenue from YouTube, or maybe they're an Uber driver, or maybe they do DoorDash and they're receiving income on the side there. Well, a lot of home buyers think, well, I can add this income to my income and help qualify because I've been receiving it. Well, here's the downside. Unless you have a 2-year history of receiving that side job, that side income, if you will, you're going to have a very difficult time getting a lender to accept it. So if you're in that scenario, just make sure you're working with a lender, you're telling them about all the moving pieces here, just so they have the full story. Now, in some cases, maybe you're getting future income. Maybe you signed a job letter and the job letter says that they're going to pay you $200,000 over the next 3 years. It's a contract, if you will. Well, chances are the lender is going to use that letter in order to determine your income because it's a contract. They know you're going to have consistent income and employment during that 2-year period of time. So there's a really good chance they're going to use that letter, but they'll actually need to use that letter. Now, here's what's really, really important, and some people don't understand this, is that lenders verify your income and employment. They're going to call your employer to verify this information. They're going to talk to the HR department, who in turn is going to verify the time frame that you've been there. Hopefully it matches up. And they're also going to verify your income. And in many cases, if you're planning on leaving the company and HR knows about it, they're going to tell the lender that you're planning on leaving. So just make sure you don't do anything crazy while you're actually in the loan process. We've actually had clients that get their verification of income from their employer while they're in the middle of the loan process and think, oh, I'm good to go. They've already verified my income and they've quit their job. Well, guess what? The lender re-verified that information prior to closing, and those people no longer qualified to buy a home. So again, if you're in one of these situations where you're planning on changing your income, you're planning on changing your employment, make sure you're talking to your mortgage professional prior to doing it, just to confirm that you're not going to have any issues. Now, if you're watching this going, yeah, I've got the income and employment piece down, but what about the down payment? What about the credit scores? What types of properties can I finance? What are the other conventional loan requirements that I need to worry about? Well, I did a video where I talk about it in detail right here.